Welcome to Yadnya Investment Academy. After our earlier videos on asset allocation and asset allocation strategies like tactical asset allocation and strategic asset allocation, this video is going to talk about dynamic asset allocation. It is usually advisable to shift your funds to debt when equity markets are rising and invest into equity when the equity markets are falling. Shifting to debt is done to book profits and avoid any losses in case the market sees correction after being overvalued. And investing into equities is done in a falling equity market to participate in the stock price appreciation when again the equity markets rise. Now you must be thinking this is easier said than done. But dynamic asset allocation is a strategy that works exactly on this principle. Dynamic asset allocation involves managing your portfolio based upon market conditions, as we just saw. It avoids the general mistake investors do of selling equity in a falling market and buying in a rising market. It is a buy low, sell high kind of a strategy where the rebalancing has no frequency as it is based upon market conditions and there's no base asset mix. And hence, the equity component can be as high as 100% in your portfolio when the equity markets look good to be invested in. Now, there are various ways of assessing the market, like using the index PE ratio, using yield gap ratio, which is a ratio between yield of equities and government bonds, inflows in the market, RBI policy stance, and index price to book value, etc. These ways can help you take a better decision, keeping your emotions aside, and build a strong portfolio even in a falling market. Let's take an example with index PE ratio to give you a better idea about dynamic asset allocation. PE ratio of a stock is its price divided by its earnings per share. For example, if the current price of a stock is rupees 100 and it has earned in all rupees 5 per share for its shareholders in the last 12 months, then its PE ratio works out to be 20. Now this was an example about a single stock, but an index is made up of multiple stocks. For example, the Nifty is made of 50 such stocks. So the PE ratio of an index is made up of weighted averages of the PE ratio of the stocks it constitutes. PE ratios of indices are available online and also come in newspapers. A higher PE ratio of an index, which you choose to follow for your dynamic asset allocation, indicates that the market is overvalued and you should sell your equity. At lower PE ratios of the index, you should buy equity. Now this table can be indicative of the proportion of equity and debt allocation which you can keep in your portfolio based upon the NSE PE ratio. At lower PE ratios, for example up to 12, you can keep your equity allocation from 90 to 100% and you can keep your debt allocation from 0 to 10%. And at higher PE ratios, you can go on reducing your equity component and go on increasing your debt component. Dynamic asset allocation makes your portfolio less volatile as you've already taken your position based upon market conditions. Be cautious as this strategy is for the informed and active investors who understand the market trends and can gauge where the market is heading. Also, on the tax front, be aware of the tax implications resulting out of rebalancing of your portfolio. A dynamic asset allocation fund could be a better solution here, as the taxes would be applicable only when you exit the fund. The dynamic rebalancing keeps happening at the back end of these funds. Also, the tax treatment of such funds is same as that of debt funds, even if the fund's equity portion could be as high as 100% at times. The fund houses are not taxed for rebalancing of the portfolio. Friends, hope you have a fair idea about dynamic asset allocation now. Thanks for watching this video. Watch this space for more such topics. Until then, happy investing. If you have any questions, let us know in the comment section below our videos. And if you like our videos, please do subscribe. Thank you.